What if I told you that in the year 2026, betting on how many hot dogs Joey Chestnut can shovel into his mouth on the 4th of July is, well, perfectly legal?
Right. Completely approved by federal regulators.
Exactly. But managing the risk of the global oil market over a weekend, that is somehow considered far too dangerous for the American financial system.
Yeah, I mean, it sounds like a cynical joke about bureaucratic priorities, right?
Yeah.
But that is the literal reality we are looking at today.
It's wild.
It really is.
Yeah.
And it's a reality that has the most powerful people in global finance deeply, deeply frustrated.
Well, welcome to this deep dive. Today, we are unpacking the Q2 2026 earnings call of CME Group, ticker symbol CME.
The world's premier derivatives marketplace.
Right, exactly. The venue where the global economy literally goes to hedge its bets.
Yeah.
So whether you are holding this stock in your portfolio and want to know if it's, a buy, hold, or sell, or if you're just insanely curious about the hidden trillion-dollar plumbing of how markets actually function.
It's just fascinating on its own.
Oh, absolutely.
Yeah.
So we're going to break this down using a really focused investor framework. We're looking at first the headline numbers, then the story behind those numbers, followed by the management guidance, and finally the bottom line for the underlying business.
Yeah, and the financial metrics we're going to cover today are massive. But I think the real value buried in this transcript is the philosophical battle it exposes.
Yeah, for sure.
Because we are witnessing a fundamental, really high stakes clash over how global risk is managed in 2026.
Pitting the legacy financial fortresses against the wild west of unregulated tech platforms, basically.
Precisely.
And we have a ton of ground to cover. I mean, we are going to explore the financialization of artificial intelligence through something called compute futures.
Which is huge.
Yes, crazy. And we will unpack that bizarre hot dog regulatory battle I just mentioned. Plus, we'll look at a CEO who is basically declaring all-out war on crypto derivatives.
Yeah, he did not hold back.
Not at all. But, to understand any of that drama, we first need to ground ourselves in the sheer financial velocity of this company. We need to look at the baseline health of CME Group.
Right, because the vital signs of this business model are incredibly robust. I mean, when you look at an exchange like CME, you are looking at an entity designed to profit from volatility, volume, and the pure need for capital efficiency.
Okay, let's hit the data. In the second quarter of 2026, CME Group pulled in revenue of over $1.7 billion.
Wow.
Yeah, that is up 1% from Q2 of 2025. It marks the second highest all-time quarterly revenue in the entire history of the company.
And it only sits behind Q1 of this very year, right?
Exactly. Adjusted earnings per share came in at $2.99, which is also up 1%. And they achieved this on an average daily volume, or ADV, of 29.8 million contracts.
I just think about that scale for a moment.
It's hard to wrap your head around.
It is. Nearly 30 million contracts changing hands every single day.
Yeah, but the metric that matters most, the one that really jumps out, is the margin.
Oh, yeah. The adjusted operating margin for this quarter was 69.5%, and the net income margin was 63.4%.
Okay, let's unpack this for a second. That 69.5% operating margin is the number that just stops you in your tracks.
Completely.
Because to put that in perspective, for anyone evaluating normal corporations, right, like a highly successful SaaS company or, I don't know, a legacy manufacturer.
They'll be thrilled to hit a 20% or 30% margin.
Exactly, thrilled. Hitting nearly 70% requires a complete departure from traditional business mechanics. It basically means they aren't scaling their costs with their revenue, they're operating a toll bridge.
Yeah, that is the defining characteristic of a clearinghouse model. They have already spent the billions of dollars and decades of time building the technological infrastructure.
Right, the matching engines and all that.
Yep, the matching engines, the server collocation centers, the incredibly complex risk management software. The concrete is poured, the bridge is built.
So the marginal cost is tiny.
Exactly. If 1 million trades cross that bridge today, or 10 million trades cross it tomorrow, the computational cost to CME barely fluctuates.
So every incremental contract traded, whether it is interest rates, agricultural products, or equities, it drops almost purely to the bottom line as profit.
Once the volume clears their fixed operating costs, the profitability just becomes exponential.
And they are taking that printed cash and handing it right back to the owners of the business. During this 190-day quarter, they returned $1.2 billion to shareholders.
That's a staggering number.
It breaks down to $468 million in regular quarterly dividends and $695 million in share repurchases.
Right. And when a management team returns $1.2 billion in a single quarter, it sends a very specific signal to the market.
What's the signal there?
Well, it means they're not hoarding cash out of fear of some impending macroeconomic shock, nor are they desperate to acquire another company just to buy their way into growth.
Right.
It reflects supreme confidence they are operating a highly defensive, cash-generating juggernaut.
But there is a hidden metric beneath that revenue and that dividend payout. And honestly, it might be the most crucial number in this entire deep dive.
Oh, the capital efficiency number.
Yes. CEO Terry Duffy dropped a statistic that illustrates the true invisible fortress protecting CME Group. He stated that CME delivered a record level of capital efficiencies, saving their customers an average of over $95 billion per day in margin.
I mean, let's just let that sit for a second.
I'm going to repeat that. $95 billion per day.
To understand why that specific number makes CME nearly immune to competition, we have to talk about how institutional margin actually functions.
Yeah, explain that, because margin can be confusing.
So margin capital is essentially a security deposit. When a massive global bank enters into a futures contract, the clearinghouse demands a deposit to guarantee the bank can cover potential losses.
Right, just like renting an apartment.
Exactly.
Yeah.
But if that bank has to place individual deposits across dozens of different exchanges for different asset classes, so equities over here, energy over there, interest rates somewhere else.
That cash is trapped.
Right. It becomes dead money. The bank can't loan it out. They can't invest it. They can't generate yield on it.
And dead money is anathema to institutional finance.
Exactly. So CME Group acts as this mega landlord that oversees all these different asset classes under one roof. Because they have total visibility into a bank's entire portfolio, they can run complex cross-margining algorithms.
Okay, so they can see everything.
Right. They can see that if a bank is holding a specific position in the interest rate market, that risk might perfectly offset a position they are holding in the equity market.
Ah, I see.
The statistical likelihood of both positions blowing up simultaneously in the exact same direction is mathematically near zero.
So CME can legally and safely say to that bank, instead of locking up $5 billion in margin, you only need to give us $1 billion because your portfolio hedges itself.
Exactly. They just freed up $4 billion for that client to deploy elsewhere.
Wow.
And they do this across the entire global financial system to the tune of $95 billion a day.
That capital efficiency is the ultimate competitive moat.
It really is. I mean, imagine a new aggressive tech startup launches a competing exchange.
Right. Trying to undercut them.
Yeah, they try to steal CME's customers by offering zero-fee trading.
Sounds great on paper.
Right. But the global bank will run the math and realize that while they might save a few $1 million in transaction fees, moving their portfolio away from CME would cost them billions of dollars in trapped margin capital.
Because the startup exchange doesn't have the volume or the cross-margining capabilities to offset the risk.
Exactly. The moat isn't the technology of matching a trade. The moat is the sheer gravity of the capital they are already holding.
Which makes the tension on this earnings call so fascinating.
Oh, yeah.
Because if CME is this dominant, if they are protected by a $95 billion daily fortress, why did CEO Terry Duffy spend half the call seemingly ready to go to war?
That is the big question.
Right. Which brings us to the story behind the numbers and the massive industry-wide fight over something called perpetual futures.
Yeah, the perpetual futures debate completely dominated the Q&A session with the Wall Street analysts. It is clearly the defining structural threat that management feels they just have to address head on.
So let's define the battleground here. For anyone who hasn't spent the last 3 years deep in the crypto trenches, a traditional future, the kind CME has traded for over a century, has an expiration date.
Right, like December crude oil.
Exactly. When December arrives, the contract expires, and it settles in cash or physical delivery.
Mm-hmm.
But a perpetual future, or a perp, never expires.
Mm-hmm.
It rolls on forever.
And the engineering trick of a perpetual contract is how it stays tethered to the actual spot price of the asset without ever expiring.
How do they do that?
They use a mechanism called a funding rate.
Okay.
If the price of a Bitcoin perpetual drifts higher than the actual spot price of Bitcoin, the traders betting the price will go up. The longs have to pay a fee to the traders betting the price will go down, the shorts.
Oh, I see.
And this fee is charged continuously, often every 8 hours, which forces the price back into equilibrium.
You know, I look at this mechanism like getting an adjustable rate mortgage, where the bank can change your interest rate every 8 hours based on market sentiment.
That's a terrifying analogy, but accurate.
And if the market moves sharply against you and you don't have the cash to pay that funding rate instantly, the platform doesn't call you to ask for a top-up.
No, there's no margin call from a friendly broker.
Right. They utilize auto liquidation. The algorithm just ruthlessly sells your position into the open market to cover the loss.
And auto liquidation is the core feature that Kerry Duffy is attacking. On the call, he was incredibly aggressive in pushing back against the entire concept.
What is he?
Well, he explicitly stated that perpetuals are not futures at all. He categorized them as leveraged spot products or swaps. He's drawing a really heavy line in the sand between retail gambling and institutional risk management.
And he anchored that argument in the composition of their customer base, right? He pointed out that 94% of CME's volume through the first half of 2026 originated from institutional customers.
Right. We're talking about massive agricultural conglomerates, hedging grain prices, multinational energy producers, and central banks.
And Duffy shared a highly specific anecdote to drive this home. He said he spoke to the CEO of the second largest energy participant in the world.
Yeah, this was a great moment on the call.
He said, I asked them 19 times if they wanted me to list a perpetual contract. And the answer was an unequivocal no.
Well, think about it from their perspective. A multinational energy company is pulling physical oil out of the ground. They need price and time certainty to hedge their real-world operations for the upcoming fiscal year.
Right. They can't have moving targets.
Exactly. A perpetual contract with a funding rate that constantly fluctuates and charges them capital every 8 hours that actively harms their ability to plan a corporate budget.
Yeah, it introduces a new variable of risk rather than mitigating risk.
Exactly. And Duffy made the point that when you calculate the transaction fees and combine them with those daily funding costs, trading perpetuals becomes orders of magnitude more expensive than trading highly efficient traditional futures.
Okay, but analyst Brian Bedell from Deutsche Bank pushed on this during the call, right? He asked about the broader systemic risk, because right now, perpetuals are heavily concentrated in the crypto markets. But there is a push to approve equity perpetuals, like a perp tied to the S&P 500.
Yeah, and Duffy's response was essentially an apocalyptic warning regarding market structure.
Really?
Oh, yeah. He pointed directly to those auto liquidation algorithms we just talked about. He said if you apply auto liquidation to a market the size of U.S. equities, which is a multi-trillion-dollar ecosystem, the results could be catastrophic.
Okay, walk me through that. Imagine a sudden macroeconomic shock. The Federal Reserve unexpectedly hikes rates, or a geopolitical conflict erupts. The market drops violently.
Right. So suddenly, the algorithms across all these perpetual platforms realize that thousands of highly leveraged retail traders no longer have the margin to cover that sudden drop.
Because it happened so fast.
Yes. So the computers indiscriminately execute sell orders to liquidate those positions.
Which creates a flood of automated selling.
Exactly. And that drives the underlying price down even further, which then triggers a second wave of auto liquidations, which drives the price down again.
It becomes a cascading doom loop.
A total doom loop. Duffy argued that allowing these products into massive foundational markets poses a systemic risk, not just to the traders, but to the global financial architecture.
Okay, I look at this argument, though, and I have to ask if this is just classic incumbent protectionism.
How so?
I mean, isn't CME just threatened by faster, frictionless technology that appeals to a younger, retail-heavy demographic? If millions of retail traders want high leverage and are willing to take the risk, why wouldn't CME just build the product, capture the volume, and take their money?
Well, the analysts probed that exact vulnerability, and Duffy's answer completely subverts that whole dinosaur incumbent narrative.
What did he say?
He stated clearly that CME has the technical specifications and the software ready to launch perpetual futures immediately.
Oh, wow, so they could do it tomorrow.
Yes. They are not technologically behind. They are making a deliberate strategic choice to refuse to list them.
He stated they will, and this is a quote, never sacrifice core protections in the name of innovation.
Which, in a financial era defined by move fast and break things, that is a profoundly contrarian stance for a tech-driven CEO.
Totally.
But he is playing an infinite game here. Duffy recognizes that launching a highly leveraged casino product might boost revenue for a few quarters, but the moment that product inevitably crashes, triggering a wave of liquidations and regulatory scrutiny,
The institutional clients will bolt.
Exactly. The clients driving 94% of the volume, the ones relying on the clearinghouse's unimpeachable stability, they will pull their capital. For CME, the trust is the product.
And, the data proves this strategy is actually winning in the open market, specifically in the crypto sector.
Yeah, the numbers don't lie.
An analyst asked about a competitor who recently launched a Bitcoin perpetual product in the U.S. market. Tim McCourt, the executive overseeing this division for CME, laid out the numbers. CME is currently doing between $4.5 and $6.5 billion a day in trading volume in their regulated cryptocurrency complex.
Right, and compare that to the competitor's newly introduced Bitcoin perpetual, which is trading roughly $270 million a day.
Huge difference.
But the more critical metric for judging institutional adoption is open interest.
Right, the total number of outstanding contracts that have not yet been settled. Because open interest shows that participants are holding positions over time to manage real risk, rather than just day trading in and out to scalp a few pennies.
Exactly. And CME's average daily open interest in crypto is sitting between $9 and $10 billion.
Okay, and the competitor?
The competitor's perpetual product has an open interest of $10 million.
10 billion versus 10 million.
Yeah.
So the takeaway here for anyone evaluating the sector is incredibly clear. When real institutional capital wants exposure to a highly volatile asset class like crypto, they absolutely do not want unregulated, highly leveraged instruments that can auto-liquidate in the middle of the night.
No, they demand the legal clarity, the deep liquidity, and the cross-margining benefits of a traditional clearinghouse.
Which is why CME is not just sitting defensively behind its walls, right? They are utilizing that trusted infrastructure to aggressively launch entirely new asset classes, capturing emerging global macroeconomic trends.
Yeah, this moves us from the defensive posture to CME's offensive playbook, and honestly, the wild frontier of new product innovation.
The most staggering announcement on this call, for me anyway, is the launch of Compute Futures. CME is partnering with a company called Silicon Data to launch the first daily benchmark tracking the spot hourly rental cost of NVIDIA H100 GPUs.
This represents a massive philosophical shift in what the global economy considers a commodity.
How so?
Well, for the last century, a commodity was something you extracted from the earth or grew in a field.
Right. Oil, gold, wheat, copper.
Yeah.
It was physical.
Exactly. Today, data centers are the new industrial factories, and computing power, the highly specialized processing power required to train artificial intelligence, is becoming a fundamental raw material.
It is the exact same economic dynamic as an airline buying jet fuel.
Yes, that's a perfect analogy.
An airline knows they need millions of gallons of fuel to operate their fleet next year. If the price of oil spikes unexpectedly, their profit margins are destroyed. So they use futures contracts to lock in the price of jet fuel today, ensuring budget predictability. Now apply that to the AI arms race.
Right. You have well-funded AI startups and massive tech conglomerates that know they require millions of hours of GPU processing power to train their next-generation large language models.
But the spot price of renting those GPUs is violently unpredictable.
Completely. It is subject to silicon supply chain bottlenecks, sudden spikes in global demand, and the release cycles of new microchips.
So before this product, how could an AI startup confidently budget for a billion-dollar training run if they had no idea what the compute would cost in 6 months?
They couldn't. There was no forward price discovery mechanism.
But CME's Compute Futures allows these companies to lock in their input costs today. It is the literal financialization of artificial intelligence.
And Derek Salmon, an executive on the call, pointed out how perfectly this integrates into their existing portfolio.
Right.
CME already dominates the contracts for copper, aluminum, natural gas, and power,
Which are all the physical raw materials required to construct and power a data center.
Exactly. Now, they are offering a financial instrument on the computational output of that same facility. A market participant can effectively hedge the entire life cycle of an AI factory on one exchange.
That's just brilliant business design. But, AI isn't the only macro trend they are targeting. We also have to look at how they are capturing shifts in global geopolitics and physical infrastructure.
Right, the discussion around Project Vault.
Yes. And I want to pause here for a second to be perfectly clear to everyone listening. The sources mention a politically charged topic, Donald Trump's Project Vault initiative. As always, we do not endorse any political viewpoints or take any sides. We are strictly here to impartially report on the factual business implications discussed in the source material. The geopolitical reality is shifting, and the physical market is reacting.
Exactly. And this initiative focuses heavily on reinforcing U.S. physical supply chains for critical minerals, specifically copper, silver, aluminum, and lithium.
The foundational elements for battery manufacturing, electric vehicles, and grid infrastructure.
Right. The analyst question centered on how this onshoring trend is impacting CME's metals business.
And the data response from Derek Salmon was fascinating. He noted that CME's COMEX copper volumes are up 4% this year. But the truly staggering metric was the physical inventory. There is currently a record amount of physical copper sitting in U.S. warehouses, just under 700,000 short tons.
And a short ton is 2,000 pounds. So we are looking at 1.4 billion pounds of physical industrial-grade copper sitting in domestic storage facilities.
Wow.
This is a direct physical manifestation of the onshoring trend. Industrial companies are aggressively stockpiling critical minerals domestically to guarantee access to raw materials, insulating themselves from potential global trade embargoes or maritime supply chain disruptions.
And because CME operates the COMEX exchange, they are the central nervous system for the price discovery and risk management of those battery metals.
Exactly. As companies scramble to stockpile and hedge that physical inventory domestically, all of that trading volume and clearing activity flows straight through CME's toll bridge.
They are demonstrating a remarkable agility to capture these global shifts, which extends to the equity markets as well. The call detailed the revival of a product that actually failed a quarter century ago, single stock futures.
Yeah, an analyst brought this up, noting that CME tried this in a joint venture back in the year 2000, and it was a catastrophic failure. Terry Duffy even joked that he's the only executive still around old enough to remember the debacle.
Right. So if it failed 26 years ago, why is CME relaunching single stock futures next week?
Well, the failure in 2000 was a product of a totally different market structure. Duffy pointed out that the defining characteristic of the 2026 equity market is hyper-concentration. We live in the era of the mega-cap tech monopolies.
The Magnificent Seven driving the vast majority of index performance.
Exactly. When market valuations for these specific mega-cap stocks become heavily detached from historical norms, institutions and large traders require highly liquid, efficient tools to hedge their exposure to those individual companies.
Because shorting the entire S&P 500 index is an incredibly blunt instrument if your actual risk is concentrated entirely in one silicon manufacturer.
Right, but attempting to short or hedge massive positions through the traditional cash equities or options markets requires deploying massive amounts of capital. By launching single stock futures through the CME clearinghouse, traders gain access to those capital efficiencies we discussed earlier.
Oh, right, the margin savings.
Yep. They can hedge their specific concentrated tech exposure using a fraction of the margin.
And Tim McCourt highlighted a critical mechanical difference between this launch and the failure in 2000. These new single stock futures will be financially settled against the closing print of the stock.
And that technical detail is the key to global adoption.
Because the closing print is the final aggregated trade price of the stock at the end of the trading day. It is highly regulated and incredibly difficult to manipulate. By financially settling against this print, traders do not have to take physical delivery of the underlying shares at expiration.
Right, and physical delivery of shares creates massive operational headaches, especially for international participants who might face cross-border regulatory hurdles holding U.S. equities.
Financial settlement makes the product infinitely more accessible to their global distribution network. It's essentially plug-and-play hedging.
But, rolling out all of these innovations, compute futures, single stock futures, battery metals, it requires navigating an incredibly dense regulatory apparatus.
Primarily overseen by the CFTC, the Commodity Futures Trading Commission.
Right. And the transcript reveals a CEO who is palpably exasperated by the current regulatory environment.
Oh man, this brings us to the most surreal, almost comedic moment of the earnings call. It really highlights the absolute absurdity of modern financial regulation. Analyst Patrick Mulley from Piper Sandler asked about a situation regarding a 247 trading contract for crude oil. CME attempted to launch this contract under a process known as a 40.2 self-certification.
And just for context, a 40.2 self-certification is a fast-track process where a regulated exchange basically submits a contract to the CFTC and formally attests, we have reviewed this, it complies with all federal regulations, and we are listing it. It is standard industry practice for established products.
Right, so CME filed this for a smaller, financially settled crude oil contract meant to trade over the weekend. But the day before it was supposed to go live, the CFTC stayed it. They blocked the launch, demanding more review.
But wait, here's the kicker. At the exact same time, the CFTC allowed a different 40.2 self-certified contract to go through without any stay or delay.
A contract allowing participants to bet on the Nathan's hot dog eating contest.
I mean, you can't make this up. Duffy's commentary on this double standard was scathing. He pointed out that their oil contract was not some exotic novel derivative. It was simply a resized version of an existing contract designed to facilitate actual global commerce.
It allows energy producers and airlines to manage the very real risk of Middle East conflict or supply shocks that happen on a Saturday or Sunday.
But a highly vital, fundamentally necessary commerce contract for the lifeblood of the global economy is blocked as too risky. And a derivatives contract tracking how many processed meat tubes Joey Chestnut can digest is waved right through.
Duffy noted the irony, stating, I guess that had an economic interest to somebody.
But the underlying critique is severe. Prediction markets tracking pop culture events are highly susceptible to manipulation and offer zero utility for economic risk management, yet they are prioritized over foundational energy infrastructure.
And the business impact of this regulatory bottleneck is real. Duffy highlighted that foreign platforms and unregulated offshore prediction markets are already offering 247 trading on crude oil. American participants, desperate to hedge their weekend risk, are finding ways to bypass the geoblocks and trade on those offshore opaque platforms.
It is the absolute definition of regulatory arbitrage. The U.S. regulators are handcuffing the highly transparent, heavily regulated domestic giant, preventing them from offering a safe, cleared version of the product, while implicitly pushing volume toward offshore entities operating outside of U.S. oversight.
It punishes the actors attempting to comply with the rules.
Exactly.
But despite the regulatory drag parachute, CME's engagement with the retail sector is actually providing massive tailwinds to the business. While they are a 94% institutional platform, the sources show their market data revenue surged 20% year over year, hitting a record $238 million. And a significant piece of that growth is being driven from the retail side.
Executive Julie Winkler detailed this dynamic. They have achieved 33 consecutive quarters of year-over-year market data revenue growth.
Over 8 years of uninterrupted expansion in selling data.
Yeah. And a major catalyst for this recent 20% surge is the explosion of simulation trading accounts, which are up 56%.
So a simulation trading account is exactly what it sounds like. It's a practice environment. CME partners with retail brokerage platforms, companies like Ninja and TopStep, to offer these emulated environments. A retail trader opens an account with fake paper money, but they are trading against the real live data feeds from the CME exchange.
And CME monetizes that immediately by charging the retail trader for the live data feed.
Which is smart on its own.
Right, but Winkler described a much more sophisticated long-term strategy here. She called these simulation environments incubators.
Incubators, I love that framing.
Because these retail partners are essentially providing the financial education that traditional institutions used to provide. They teach young retail traders how market mechanics work, how to read order flow, and most importantly, how to manage risk without blowing up their accounts using 100x leverage on a crypto app.
They learn the discipline of trading in a safe, controlled environment.
Exactly. And once they prove they can be consistently profitable in the simulation, they graduate. They transition into real funded accounts. They become sticky, long-term professional data subscribers, and they begin generating actual transaction fees for the exchange.
So CME is organically farming its future customer base while getting paid for the data along the way. That's just an incredible flywheel.
It really is.
Okay, so we have looked at the massive revenue generation, the defensive moat against perpetuals, the offensive push into AI and metals, and the regulatory hurdles. Now we need to look at management guidance. What did the executive team officially signal for the back half of 2026?
Well, the technological centerpiece of their forward guidance is a major product launch slated for the fourth quarter called Treasury Link.
Treasury Link, okay.
This is a profound upgrade to the deep financial plumbing that moves trillions of dollars globally.
So, to grasp what Treasury Link does, you have to understand that the U.S. Treasury market, which is the bedrock of the global financial system, is fundamentally bifurcated. You have the cash market, where actual physical U.S. Treasury bonds are bought and sold. CME owns a massive platform for this called BrokerTech.
Right.
On the other side, you have the Treasury futures market, which trades directly on the CME exchange.
And massive financial institutions constantly trade the spread between these two distinct markets. They might buy the physical cash bond on BrokerTech and simultaneously sell the futures contract on CME to capture arbitrage opportunities or manage their duration risk.
But historically, Executing this strategy exposed the institution to lagging risk.
Right. And lagging risk is that terrifying millisecond of exposure. In the legacy system, a bank had to execute the trade in the cash market and then algorithmically sprint over to the futures market to execute the opposing leg of the trade.
Even if that process takes a fraction of a second, the market price can move against you while you are exposed in the wind.
And in modern algorithmic finance, a millisecond delay can cost an institution millions of dollars.
Ouch.
Yeah. But Treasury L&K solves this by physically and digitally connecting those two massive liquidity pools. It enables a process they call atomic execution.
So the trade doesn't happen in sequence anymore. It happens atomically, simultaneously.
Exactly. It allows an institution to swap a physical cash bond for a futures contract in one single instantaneous motion. It completely eradicates lagging risk.
Because the price cannot change while the trade settles, because both legs of the transaction execute at the exact same moment.
Yes. This technological upgrade will undoubtedly drive massive algorithmic volume to both the broker tech and the future sides of their business, as institutions realize they can execute spread trades with zero slippage risk.
And that volume momentum is already showing up in the current data. Management noted that July average daily volume is tracking 18% ahead of the same period last year. That is a massive acceleration on top of an already record-breaking first half of the year.
There was also a subtle but critical personnel note regarding leadership stability on the call. Throughout the Q&A, analysts repeatedly congratulated an executive named Lynn on a promotion.
Yeah, while the specific title wasn't spelled out in our source segment, the context strongly implies an elevation to president or a similar top-tier operational role.
And when asked about her strategic vision for the future, she made a point to state that it is not a radical departure from what CME has delivered over the last 2 decades.
No pivot to becoming a tech conglomerate. No debt-fueled M&A spree on the horizon.
Right. The guidance is essentially, we are going to continue running a world-class clearinghouse, launching targeted products, and optimizing capital efficiencies.
Which brings us to the bottom line for this stock. Based on the totality of this earnings call, the 69.5% operating margins, the fierce philosophical defense against retail perpetuals, the agility to launch AI compute futures, the regulatory battles, and the atomic execution of Treasury liquidation. What is the final verdict on the underlying business?
Well, if you are an investor holding the stock or someone analyzing the market structure, the data points to a fiercely bullish outlook for the business mode.
A lot of market commentary is terrified that shiny, unregulated crypto apps and offshore retail platforms are going to eat the lunch of legacy financial institutions.
But the evidence presented here suggests that perceived threat is largely a mirage. It is a highly visible, loud distraction. Retail gamblers utilizing 50x leverage on offshore platforms with auto liquidation algorithms is simply not the business CME is in. The 94% institutional volume metric is the anchor of reality here.
The multinational corporations, the global banks, the sovereign wealth funds, they cannot and will not utilize a product with unpredictable 8-hour funding rates to hedge billion-dollar fiscal supply chains.
Exactly. They demand the absolute certainty of CME's clearinghouse and the $95 billion of daily margin savings that only cross-asset algorithms can provide.
Yeah.
That core business is structurally insulated from retail tech disruption.
Furthermore, their offensive agility proves they are not a stagnant monopoly. They recognize the macroeconomic shift toward domestic physical infrastructure with Project Vault and position their COMEX copper contracts to capture the stockpiling volume.
And they saw the defining technological explosion of our era in artificial intelligence. Instead of trying to build a better language model, they built a financial toll bridge right in front of the data centers.
By turning GPU processing power into a tradable commodity, they are instantly monetizing the AI boom without taking on any of the venture capital risk.
Right. The only legitimate headwind identified is the friction of the regulatory state. The absurdity of prioritizing hot dog eating prediction markets over vital global energy infrastructure is a drag on innovation.
But even with the CFTC acting as a regulatory parachute, they just posted the second highest quarterly revenue in their history. The underlying physics of the clearinghouse model are simply too powerful to be derailed by bureaucratic delays.
It is a masterclass in aggressive market dominance wrapped in the boring clothing of legacy finance.
Well said. My friend, thank you for guiding us through the immense complexities of this ecosystem today. We have traveled from the systemic risks of crypto auto liquidations to the physical copper warehouses and into the algorithmic atomic execution of U.S. treasuries.
It was an incredible landscape to analyze. But before we close, there is a lingering implication regarding those AI compute futures that we only touched upon, and I think it is vital for the listener to consider.
Boy, yes.
CME is turning the raw processing power of artificial intelligence into a globally traded, hyper-liquid financial instrument. We have a century of historical data showing what happens when a vital resource becomes financialized.
Right, we saw it with the oil markets, we saw it with agricultural staples, and we saw it with housing.
Exactly. If compute power becomes a globally traded futures contract, will that actually stabilize the AI arms race, allowing brilliant startups to predictably budget their engineering costs? Or are we simply building the infrastructure for Wall Street speculators and macro hedge funds to hoard and manipulate the cost of artificial intelligence, ultimately controlling the future of the technology itself?
That is the trillion-dollar question. We started today talking about how regulating the global oil market was deemed too risky. What happens when the regulators have to figure out how to manage a speculative bubble on the intelligence of computers? To everyone listening, thank you for joining us on this deep dive. Keep questioning the headlines, look for the toll bridges hidden in the data, and we will see you next time.